100,000. The bank says the maximum they will give you on that property is 75,000. So you borrowed 50,000. You've paid back 25,000. So your equity on redemption is the unencumbered portion. So the unencumbered portion is the 25,000 difference between the 25 and the 50 that you borrowed. And then you also have, since the bank will lend you up to 70, 75, you actually have up to 50,000 that you can borrow from the bank. All of that is unencumbered. So once you get a mortgage, it implies the transfer of the mortgagor's interest in the property as security. So that's a concept that you have to understand. When you get a mortgage, you're transferring the interest in the property as a security. So when you hear someone say they have a mortgage, always think of it as the bank is holding that interest as security. Because, you know, people normally walk around and say, oh, well, the bank is holding all my land. The bank is holding my land papers. The bank is actually holding an interest in your land. That's their security. And then once you've paid off your debt, then it's transferred back to you on the satisfaction of all your obligations, which include paying the stamp duty. The difference between a mortgage and a charge is the charge just gives you a right over the charger's property to satisfy an obligation. So you're not transferring any interest. It just gives you a right. So when you always talk about a security as being an interest, there are two distinct things you have to think about. What is the nature of the interest in the land or the collateral? So who is ever coming to borrow, you need to know what interest do they have. And then you have to figure out whether or not that interest is freehold or whether it's leasehold. Whether it's legal or whether it's equitable. And of course, the land itself may be unregistered. So you know what that means. A title search has to be done. Then you also have to think about the nature of the security interest created. That is, whether you're doing a legal or an equitable mortgage or you're doing a charge. So when you have a secured loan, the borrower gives the lender an interest over the land. And that interest over the land gives them a right in priority over the creditors. And they also have the power to be repaid the loan. Now, enforcement of that right that the mortgagee has and any legal action is all based on the law relating to mortgage. So even if you have a court order to put into effect a power of sale, that does not make the mortgagee the legal owner of the land. You understand what that means? So even though the bank can exercise his right to say he has a power of sale, it doesn't make him the legal owner of the land. He still only has that interest in the land that he's holding as security. And what he's doing when he exercises his power of sale is that he's just exercising his right to dispose of the land in order to pay back his debt. So I know in the last, I guess, when we had all of the mortgage defaults, and I know they're still going on now, but a lot of them were sold in a bulk sale. A lot of people were complaining and mumbling and grumbling that their property was sold, they lost their home, the bank didn't do all it should do, they should have waited. And I guess we'll see the same thing coming at the very end of COVID also, when a lot of people don't have a job to go to, and the bank can no longer hold on to those houses. And so the bank, when it disposed of it, is merely just exercising its right. And that right is in the contract itself, and that right is by law under the law of conveyancing. Of course, once they sell it, if there's any surplus, then it goes to the mortgagor. And that's subject also to whether or not you have any other debts that you owe the bank. So when we speak about equity of redemption, we know that when you enter into a mortgage, it is a contract, a legally binding contract. And by entering into that mortgage, you as the borrower, you give the bank your legal interest, or you more or less, you give them the right over your property. And you do that in order to borrow funds, either to complete your home or whatever purpose that you're getting the mortgage for. And when you do that in the contract, you have a legal obligation to pay on a certain date, on a certain frequency, for the currency of the mortgage. So the mortgage acts as a security for the mortgagor to perform. Because once you don't perform, after 3 consecutive payments, then the bank then decides it's going to take an action. Once you perform it, then the land, of course, is released. And the mortgagee's right or the legal interest in the land is free from any personal obligations. So if you as a borrower fail to discharge your obligations under the mortgage loan, and your main obligation is to pay, then you are in breach of contract. And once you're in breach of contract, the bank has remedies, which we'll get to the end. So under the equitable principle of equity of redemption, everybody understands what equity means? Yes or no?
One sec. Yes, ma'am.
Okay, all right.
Yes, understood.
Okay, so under the equitable principle of equity of redemption, the mortgagor has the right at any time after repayment to pay the loan and redeem his security. He has to give notice of repayment or pay the interest on the mortgage loan over a period of time. I know there are some mortgages where you cannot pay it early, there is a penalty. And so you always have to read what are your obligations as the borrower. Some people decide to make principal payments only and then have the regular mortgage payments in between to reduce the time period. But you have to be careful that there's not a clause in the mortgage which tells you how much payments you have to make before you can repay. So even though in a loan or any financing arrangement, the equity or the equity of redemption in the mortgage is the value in the land. The difference between the amount borrowed and the amount owed. So the equity of redemption is the general right of the mortgagor to redeem his security and discharge the mortgage. So if you go back to our first example, the property is worth 100,000, you're eligible for 75, you borrowed 50, you've paid back 25, and so your equity of redemption is now at 25,000. Of course, you know, the bank will call you because they want you to keep refinancing it up to 75,000 and keep your property longer. Because that's how they make money.
Good question, Ms. Archer.
Mm-hmm.
So in the case where you said about if you fail to pay three consecutive payments, and the bank, has their actions of recourse, their remedies, and they can sell your house if they feel like that's the only way to recover their funds. They can sell your house. What about after some time you've paid off your house and you want to sell your house, right?
What do you mean? Without...
Okay, so I got my house for $100,000. I bought it from the bank, and I paid it down. I have an equity of about $50,000 in my house.
Okay.
And the bank still has, their $50,000 interest in my house.
And
I want to move. I want to sell my house. Okay. Well,
you can do that.
I can do that. I need to let the bank know that I'm doing that, of course.
Notice.
Okay. And then I guess what will happen is I'll, from the proceeds, I'll pay off the bank loan.
They'll take that up, because when the check is drawn up, the check is going to be in favor of you and the bank.
Okay.
So that's where the bank ensures that they get their portion.
Okay.
And then you get the difference.
Okay.
Well, people do that all the time.
Yeah.
Yeah.
I just want to know, in terms of logistics, how does that work in terms of letting the bank know, since it's technically still like they haven't released, my security as yet.
Right. So you give them notice that you intend to sell. And once you have reached an agreement with whomever wants to buy the property, you advise the bank that I have a prospective purchaser and this is going to be the sale value.
Well, here's my question.
Okay.
I know, and a follow-up question. I know that sometimes they put in mortgage clauses that you cannot, let's say, pay down your principal or pay down your mortgage ahead of time without a penalty or before a certain time, because it messes with their... You getting to that?
No, I said I mentioned that already.
Right.
Yeah.
So because at the end of the day, they don't want to, have their investment, I guess, come due earlier than they expect, in some cases.
They calculated their revenue from that.
Right. So in the case now where, okay, my mortgage was a 15-year mortgage and in 10 years I want to sell my house, they're still losing the revenue that they thought they would have had. But there's no penalty for that. There's no penalty for me selling my house, even though they're still losing out on 5 years worth of...
As long as you've gone past the period where there is no penalty. Because you have to think about it. The bank has deposits, and then it has the loans on the asset side of the book.
Right.
And they're balancing these things by dates.
Right.
And so if your contract says that you cannot pay down earlier than 10 years, and you decide to pay it in 8 years, there is a penalty for those 2 years.
Right.
And they're going to take that from the sale.
Right. Okay. So now in the case, like I said, in the case now where I want to sell my house before it's time, right? Will the bank penalize me for selling my house because that they're losing on a revenue, not just...
They're going to penalize you. And that's why I said earlier, you have to read the terms of your mortgage contract. You have to read the terms.
Okay.
Because if you decide, let's just say you had a balance left of 25,000 and you got a bonus of 30,000 and you decide, okay, I want to pay this off. But in your mortgage contract, you had a currency of at least 10 years before you can come and pay this off, and you're only at year 5. You have 5 years interest you're going to owe them, and they're going to calculate that.
Wow.
That's why I say you have to read these contracts, because you're going to be in breach, and the bank is not going to suffer a loss. So you have to be very careful when you sign it. That's okay. When you go for a mortgage, normally they have a standard. They're going to tell you this is what we're offering. And what behemoths don't do is they don't negotiate. So you're supposed to know, okay, I want a 25-year mortgage, or I want a 15-year mortgage. I want a 10-year mortgage, as long as you can make the payments and you can fit within the debt service ratio. So when you go for a mortgage, you need a plan for the future. Do I want this long? What if I know I'm in a industry whereby I get lump sum bonuses? So you're already calculating that. Guess what? If I get on average a bonus of 5,000 a year, in 5 to 10 years, I'm ready to put a lump sum payment. Then you got to make sure that the contract is in line with what you envision. Because if you don't pay the lump sum, it doesn't impact you at all. But if you pay the lump sum before the time, you're going to be penalized because the bank is going to lose revenue. So always try to negotiate. The banks will always try to push on you a standard whereby you fit within their little cookie cutter. But you can negotiate.
Can I ask a question?
Go ahead, Owen.
We are referring to the legal equitable mortgage or a charge. Can you define charge? I think I know what it means. Could you elaborate on that or define it clearly for me, please?
Okay, so a charge is just having a right over property. There's no transfer of interest. You can't see it. It's just written that I have a right over your property.
Until everything is paid off.
Until everything is paid off. Versus when you have a mortgage, you transfer in your interest. You see the difference? You're doing a transfer.
Yes.
With a charge, you just have a right.
Okay.
Yeah.
Hey, Ms. Archer, is it possible to have an example of a charge or where that would be applied?
A charge over property? Give me a couple minutes. I'll figure one out for you.
Okay, thank you.
Yeah, I'll figure one out for you. So you understand now when you pay early, there is a penalty.
Yes. Yes, thank you. Sorry, on the risk of going off on a tangent.
No, go ahead.
What would be some tools that you can come to a bank with in order to negotiate things in like your mortgage, right? I touched this subject, I think, before in another class. And one of the things that the instructor said is things like having a sizable down payment.
Yes, that's the first thing I was going to tell you.
Is there any other thing? Because the average, like you said, the average Bahamian doesn't know that they can negotiate. And if they did know that they could, they probably wouldn't know how. And it's not just, having a poker face. What tools can you say as because I think everybody in this group is young professionals. What would you say in a more practical approach? What could you say that is a good negotiating tool to be able to say, we could do better than this, or, my risk factor is lower, so I could get better than this, or whatever the case may be.
Yeah. So the first thing you have to look at is before you go to any market, you have to know what the competitors are offering. You have to know what they're offering. You shop around. So if I go to Bank A, they're offering me whatever percentage. B is offering this. There's a variance between each one of the banks and what they're offering and why they're offering it. So that's the first thing. The second thing is if you're getting a mortgage, what else are they going to give you in addition to that mortgage? Because you just don't want to go to a bank and just get a mortgage. You want to be able to facilitate other terms of credit easier because you have a mortgage there. And then, of course, it's always the down payment. The more down payment you place, then it's the shorter term. But rather than placing a larger down payment, what you can do is give what is required and place the rest of the funds in a fixed deposit. So you give yourself more leverage and more room in order to borrow in the future if there is an emergency. But whenever you have a mortgage, you have to look at your work lifespan, how long you intend to pay for that, whether you're going to stay in the same job, whether or not you're going to make lump sum payments, or you're going to make principal payments during certain times of the year, or half a year, or in year 2, year 3. You have to sit down and figure that out, and then compare to what is being offered by each bank. And then you negotiate. what your interest rate will be. Because, go ahead. No, one more thing. Because when a bank advertises that we are offering mortgages as low as, in contract law, that is called an invitation to treat, which means that they're telling you, come in. But that doesn't mean that you have to take that rate. They're going to give you the best rate that they can if you fight for it. They're not going to go too low. They wouldn't give you one that they would give someone who has more money than you, but they will give you a better rate, even if it's 0.5%. But you have the bargain for your rate.
Okay.
Someone was going to say something just now.
No. Oh, that was me. What I was going to say is another thing, I guess, with the average payment as well. It's not just a matter of negotiating for talking's sake, but also being in the position where you can negotiate from, being qualified and everything else.
Yes, yes.
Yeah, the average payment tends to be on the borderlines of, yeah. So basically,
don't forget the credit bureau is coming into effect very shortly.
And that will make it worse.
It down. That'll make it what?
That'll make it worse.
Why?
Because a lot of persons actually get qualified because of what we don't know. So imagine.
I agree. But
well, then I think that all that's going to happen is that they'll just lower the standards. At the end of the day, the banks still have to make loans to make money. That's how they make money.
So what I learned last night is that the credit bureau and the banks are already in the trial phase, sending dummy-like accounts, going through the system and generating it. So at the end of the day, when they put in the actual information and they get the results and they see the dismal look, of course, all of the banks are going to have to come together and sit down with the government and the central bank to make a decision as to what's the next step. Because just like you're saying, they really don't know what is out there. Because the people are borrowed all over the place using the same security or same salary. They're minus 50 and each borrower doesn't know.
COVID ain't gonna help either.
And COVID won't help either. If you saw in the paper today, the union chief is asking persons to try not to push it to get money from the employer. Because if you lose your job, there's no guarantee you're gonna get it back. You join the pool of the unemployed and then you have to fight for your position. So you should wait. Even though it's hard, it's better to wait and be employed than to rush, get your money, and be unemployed. So those who are already working in the banking industry, you have family members, you have to try to encourage them to hold on because we don't know how long this is going to last. And the banks are going to be in a really hard position when those persons who had jobs no longer have jobs and all those houses are going to go up for sale. And if they go for sale, where are these people going to live? And who are you going to?
I don't think they're going to let anybody. Honestly, I think it's because everybody's in the same boat. I don't think they're actually going to remove anybody from their homes because it's actually going to cost the bank. I know this happens on some of the family islands. It actually costs the bank more money to upkeep, let's say, a distressed property to sell it than to kick some, you know what I mean? It's cheaper for them to just let the people stay in the house until they can find a buyer and then they kick them out. Otherwise, a house just being,
But in the last crisis what we had 4 years ago, what did the banks do?
I'm not sure. You tell me.
They kicked them out. They kicked them out.
Boy, I don't see them kicking this much people out. And to be honest, like I said, everybody's in the same boat. Now with COVID and the unemployment rate and how much people are going to be on a job and being unable to, service their mortgages, I don't think they have the manpower to kick everybody out. You know what I mean? Like I said, as opposed to, let's say,
Yeah.
when you have it could still be a foreclosed property, you know, and it could still be up for sale. So until they find a buyer, they may not kick the person out until they actually have somebody looking, you know, to buy the house or interested in the house. Simply because it's not feasible. I just don't think it's feasible, and it's not economic. That's just what I think the bank stance is
Yeah.
going to be.
They haven't crossed that bridge yet.
Ms.
Notice they haven't
Archer,
crossed that. They're not having that. No. Go ahead.
I just wanted to know, do you know what the bank's reservation is for not wanting to enter into a subsequent lease agreement with their former mortgagors? Because sometimes when the properties are foreclosed and you then go to you take a long time to sell it, the reality is sometimes most times the mortgagor doesn't have anywhere to go. I know that sometimes the banks refuse to take the little bit of money that the mortgagor can pay. And then they kick the mortgagor out, and the house is just there and it gets dilapidated. And as the lady before me stated, it costs more to upkeep the distressed property. And sometimes I would ask, why wouldn't the bank enter into a lease agreement with these people, like to just accept the little bit that they have? Because the people, they want to maintain their house, and I'm pretty there are lots of people who, if they could, they would pay their mortgage. You have people who just bad pay, but there are most times people want to keep their roof over their head. So why not in that instance, like encourage that type of relationship or that type of avenue for banks? I mean, I don't understand why they don't sign on to it or do it.
Okay, so not a lease, but I know in the last housing bubble that we had here locally, what they did was when one of the partners got a job, let's say both were unemployed, when one got a job, what they would have done is they restructured the loan.
Right.
They did a lot of restructuring and extended the mortgage out further. So a lot of people are going to be paying mortgage until they're about 70 now. And then they lowered the payments. And they encouraged them that whatever little change you have, you could come and make a deposit to make up your monthly payment. They encourage that.
Sorry. The government has the Home Owners Protection Act. And I think basically that's all about making sure that the bank acts morally and justly in dealing with matters.
But they did that afterwards. Yeah, but they
Sorry?
did that afterwards.
Oh.
No, that came out after.
All right.
Well, yeah, that came out after. So if I look at her question, what they did first was they tried to restructure the loans, extend them further, reduce the payment if one of the partners was working. But when there were no partners working, remember now, the majority of these domestic banks are foreign owned. They weren't interested in leasehold. They weren't interested in anyone staying in the house. As far as they're concerned, we need to get our money. We need to get these assets off our books. To them, it's just business. They're not thinking about people. This is business. We're not going to keep these assets on our books because these houses over time are going to become dilapidated. So they started out first, they had you move out, and then they had real estate persons to go check the property, make sure the houses were in order, make sure nobody had broken in. And then as it began to multiply more and more and more and more homes, they decided we have to do a bulk sale. That's the decision they made. And that's when the people began to cry more and more. That's when the government said they're going to bring in this mortgages home protection bill. But that was after the fact. A lot of people had lost their homes. Now with COVID, I haven't heard anyone mention about the mortgages homeowners bill and how that's going to impact these persons who would not have paid their mortgages for almost, by the time this is over, a year and a half or 2 years. because both partners are unemployed. It's going to be a serious issue.
Mm-hmm.
And whether the government is going to try to absorb some of those things to try to help people get on a good foot, that's another issue. The country is already heavily in debt. It's something we have to think about. So if I go back to the question where he asked me about the charge, what is the charge? Okay, when you think about property from land law, you think about interest in land. If you look at property from more like from an accounting standpoint, property is either movable or immovable. And the charge is over immovable property. So let's say if you have a business, you can put it over a charge over the land. You can do a charge over, sometimes you can do it over the inventory. You call it a floating charge. So there are different ways you can do a charge. You can identify the assets in your organizational structure that's going to cover the charge based upon what you borrow. Because normally you put it over land, you can put it over goods, you could use it over goodwill. If you have a goodwill in your business, you can say that I'll have a charge over the goodwill. So there's different ways to do it. You can use intangible assets. Like if you have a particular right in a trust, you can say, I'll have the bank exercise a charge over my right. But remember now, with a charge.
Ms. Archer.
Yes.
Sorry, Ms. Archer, would assignment of rents be something like that?
An assignment of rent, yes, similar.
Assignment of rent. Okay.
Yes.
Okay.
Yeah. So you're just doing a charge over whatever it is that you intend to get. There's no actual legal transfer. So clause on equity. It means that the bank cannot impede your equity or redemption. So you always ought to be able to pay on your loan. And it's always said that the borrower cannot place undue postponement of redemption. They're taking it further out and further out and further out. And that's why I always tell people, when you have a mortgage, every 2 to 3 years, go and check your balance. You have to realize that these things are all computerized now. So as you make your payments, you have to make sure that your payments are being deducted and being deducted in the right way. And every time you're late, you know there's a charge for that. Because I've seen mortgage people were constantly late, and when they thought the mortgage was finished, when they got to the bank, they were nowhere near finished. Because they were always late, the system applied it differently. And so they always were behind, always behind. Interest was accruing. So you have to always check your mortgage. If you're paying on time, then your balance should be X amount, and you have to confirm it. If you're not paying on time, at the end of each year, you need to go and check what your balance is, what your balance should be, so you can bring it current. Because otherwise, at the end of that period, you're going to go and say, oh, my mortgage is finished. And when you go to the bank, you get a surprise. You have to pay an additional $10,000 to $15,000 because you were not paying on time. So the protection and the perfection of security or mortgage interest. So we know as a colony, we follow English law, English common law. And under the Law of Conveyancing and Property Act, that requires us to record the filing of the mortgage document and the conveyance, and of course, paying the stamp duty. And we do the recording because we have to perfect and protect the security interest of the relevant parties. And you do that against any third party who may decide that they have a claim against that security. Of course, if you have a security interest and that security interest is not recorded, what you can do, if there is someone who is interested or who says they have an interest in that security, you can actually give them notice by writing to them to say, I have an interest in this property in the amount of so-and-so for a currency of 15 years. Another thing you have to remember is that the title search, a thorough title search, also tells you whether there anyone else who may have a claim against the property, or anyone who may have an adverse title against the property. And that's why you see whenever you go to apply for a mortgage, even though that property may have been mortgaged before, like the example she gave us where she said she has a mortgage and then she's going to sell her house during the mortgage to someone else. That person who buys her house has to go through the same title search that she would have gone through. And they do that because they're looking for any adverse claims against that property. So the object of the filing or the lodging of the document or the mortgage document is to give notice of security to third persons.
Wednesday, Thursday, and Friday.
Notice that failure to file
Sure.
not affect the enforceability of the security.
Good night.
So notice that even though your mortgage is not filed, it doesn't stop the bank.
I'm in class. I don't know where the dogs are. See if they're not over by you.
Sorry, someone's speaking while you're talking. Can they mute their phone, please?
Okay. Now in law, when it comes to property, they have a Latin saying. I'll give you the English. The first in time prevails, which means that when you have an interest, once you record it, you are first in time, and everything goes from the person who has the first in time in terms of registering their document. It doesn't matter when the document was created, it is when it's recorded. That gives notice to the third parties that someone has an interest in this security. Now, of course, if you fail to record your interest and that property is sold to what we call an outright purchaser or bona fide purchaser for value without notice, then of course you would have lost your interest. And it says, and that means that there's been no fraud or no collusion. So that purchaser has to be someone who had no knowledge at all that there was a mortgage related to that property, bearing in mind that you did not record your security. So if you omit to give notice and you leave the property under the mortgage's control, and a second mortgage is given out on that property, always the first mortgage, you have to let the second one know of its indebtedness. I know a lot of banks now don't do second mortgages unless it's with them themselves. But beforehand, people used to do first mortgage at RBC, second mortgage at BOB, third mortgage at another bank. That's what they used to do. So filing the mortgage is important because one, it gives notice. And two, it protects your interests.
Didn't you say that because of the slow registration process that it's still possible for people to do that? Like that's how it was done back when.
Yeah.
And that's still a possibility to this day, is it not?
Yes, yes.
And what happens then? What happens then if the multiple mortgages, the banks become aware of them? Let's say everything going fine, the person paying their mortgage, no issue. But 10 years in the mortgage, they find out about each other.
And whoever's the first one to be recorded takes the first lien.
Okay, but they.
Okay,
but
so I have
sorry, I'm saying, like I said, if everything they're paying the mortgages, right? There's no issue yet. There's no reason for foreclosure. There's no, issue like that. Would they actually kind of like? Would they take the person who has the mortgage with them, like, to court to get the other mortgages settled? Like, how would they deal with that?
No, only if there is a default.
Okay.
Okay. So say you have one piece of property, but you have 3 loans, 3 different banks, and bank number 2 then realized that bank number 3 has one further down in there, but they're all paying. So even though he is paying, there is a possibility that there may be a default. So the second bank, realizing that there is a third person who in his mind is a second person, will rush to make sure that their interest is secured. Everything when it comes to recording is who is ever's first in time. So if number 2 is the first to be recorded, if there is a default anywhere and that property has to be sold, they will be paid first. Then the first and the third then have to figure out between the 2 of them to race to see who's going to be number 2.
Because I'm thinking that, part and parcel of the whole mortgage process is that in some way, shape, or form, the bank can tell me what I'm even eligible to get a mortgage for or get a loan for, right? So let's just say that I want to buy this piece of property for $300,000, right? I have a steady job and, all intents and I'm planning to pay my bill, but based on either my down payment or their assessment, they only want to give me a loan for $100,000.
Yes.
In theory, I can go to 3 different banks and get $100,000 worth of mortgage and buy my $300,000 property. Could I not?
Yes, you can. You can. You can.
And go about my business, paying my bill.
You can. You can.
I don't see why I mean, I understand that the bank's interest if it default, but other than that, I feel like that's good business on my part. If I'm restricted to what they tell me they can lend me.
Exactly. So long as you can meet the debt service ratio and you have the equity in the property based upon whatever valuation they provide, then there's nothing wrong with that. Then they must each go and record their security interest in that property.
And there's nothing legally barring that from happening. That's the next thing, right?
No. It's just that the banks themselves don't like to do it.
Okay. All right.
Yeah. I was just going to say that.
No, they don't like to do it. They like to have the whole security all to themselves. And if you need more money, they prefer to take that existing loan you have after you've made certain payments. They say, oh, she looks like a very good borrower. And then they will just give you more money and extend the loan or keep it where it is, increase the payments. They'll do whatever it takes to keep you.
Because I'm thinking, let's just say I'm married. Me and my husband will go to different banks and get a loan on our property, 2 different mortgages. You understand? For the sum total of what we want it to be, and we could make that work. Why not?
You can, but when he goes to get his mortgage or you go whichever one, it depends. Unless your bank has not recorded it as yet, y'all may be able to get away with it. But if your bank is fast and they recorded it right away, then the other bank is going to say, hold on, you already have a first lien on this property. And they're going to send him back to the bank that you went to. You just don't like to do second. But that's a bank decision.
Okay.
Yeah, it's a bank decision.
Ms. Archer.
Yes.
Sorry, I have a question. At any given point in time, can two different creditors hold legal interests in one property?
Yes. It'll be the same example we was just giving, where you have two different banks.
And they can both record?
Yes, they can. But I'm saying the banks don't like to do that.
Okay.
Yeah, they don't like to do that. They don't like that.
I'm sorry, I'm thinking about how can it even happen in the first place, right?
What do you mean?
Meaning, if my home was for $250,000, right? The bank will know how much this property is worth, what it's appraised at. That's part of the process, right? And if I come to them and I say, hey, I only want a loan for $150,000, which clearly isn't enough, $125,000, which clearly is not enough to buy this house, right? But that's the mortgage I'm, interest in the mortgage I'm borrowing from them. How could I even get away with that? The first question would be like, why you can't buy this house because you only have half the money. Because I wouldn't go to the bank and borrow $250,000 and let my husband go to another bank and borrow $250,000.
No, you can't do that one. No, you can't do that one. That's fraud.
That don't make no sense.
No.
That's the real estate. The real estate person is not going to do it either.
No.
Right. So I'm saying, how is it even possible then that property, right? Unless two people are getting the mortgage for the entire amount of the property, which I don't understand why that makes sense for the person borrowing if they have to pay.
Correct.
Is it more money? Yeah.
But people were doing it before,
How and why? Because it isn't like they see that or touch that money themselves.
Yeah, but you're getting one to buy it, and the other one maybe to do repairs, buy furniture.
Okay.
They find different ways to do things. And then when they get further down the road, they can't pay for it. And then banks realize that, hold on, we're holding the same security interests. Who's first? And sometimes what happened is the person who was second can't be repaid. That happens too.
That happens in a shady business. That don't happen in real.
No, that happens for real.
No, I mean real, but I'm talking about it must be a shady transaction.
Yeah, shady because you keep borrowing money and know that you only have so much.
Yeah, but the loan person has to be involved in that shady business too.
Of course. What are you think shady things happen? Because he's getting his little cut on the side at the same time.
Ms. Archer, I can't speak for other banks, but I know RBC has taken steps to, I guess, amend that issue that used to happen back in the day. And so now we hold the attorneys that would be responsible for recording the mortgage. We hold them accountable, and so they don't get their legal fees until after they deliver that document to us to say that it was stamped and recorded. And now I know a financial institution that would still take out a second charge or is rumored to still take out second charges, but it seems like what they would do is negotiate that with the client knowingly, and they would wait until the bank, whomever bank the client is with, stamps and records their document. They would hold that document until then, and then record their second charge.
Okay.
But no face, no case. I won't call the name.
Yeah,
first
but
no, not them.
No, not them. It's the other one.
It's the other one.
We can leave it right there. The other
one.
Leave
it right there.
Oh, that one.
Yeah, that one.
Figure it out. The other one.
The other one.
The other one, where you can get a loan very easily.
Good afternoon, Miss Archer. Can I ask you a question?
Go ahead.
So this doesn't have anything to do with what you're talking about. But let's say you have a mortgage with a bank, right? And then you go and you want to take equity out of your home. So you got the original home loan as a home loan, right? Go back to take your equity out of your home loan, but you've of course made some, you've made some changes where you've put like apartments, like let's say it was like an acre of property, and you made like an apartment building in the back of where the house is that you bought from your mortgage, right? They didn't help you build these apartments, right? You build these out your pocket, right? So you go back to them and you say, okay, well, now I want to take some equity out of my property, right? And obviously when they, you have to get appraisal, right? And so appraisal now shows all of the added things that you've done to the property, right? Is it, I guess you can't say it like that. Okay, so why do they want to turn it into a commercial mortgage then? Why can't they just front part? Why are they looking at them pieces in the back there? That piece in the back there have nothing to do with that.
No, but you turned it into commercial.
You turned it into commercial.
You see what I'm saying? Like that didn't have to do with them. They helped me build them.
You turned it into commercial automatically.
Why?
Yeah, you turned it into commercial.
Yes, I understand that part, but that ain't have nothing to do with them.
No, hold on. When you built your home on that, you built that as your residential home. When you built apartments on it, you had to have gotten approval from town planning because you went from residential to commercial.
It was ever multifamily, so they didn't tell me that. Where I
No. If your land was already zoned as multifamily and you went and you put one house on it. Well,
no, it ever had just one house.
Yeah, but now you went and you did what you're supposed to do. You made it a multifamily. It's rental income. You can't run from rental income.
Okay. So how do you circumvent that?
What?
Kind of thing?
You don't.
What's the big deal between a commercial loan and the residential loan? Is it a different rate?
Yes.
A different rate and a different length of time, because
all of the terms are different.
More expensive.
All of the terms are different. Yeah. So commercial loan, they only give you 15 years. Then they ask you for more. The payment is more. The interest
real property tax or
real property tax, exactly. But guess what? I'm not paying any real property tax.
You will. It catches up with you. It catches up with you, my dear.
Don't forget now, when she goes somewhere and she wants to get a certificate of good standing from NIB, the Department of Inland, you say, real property tax is not paid.
They ain't charging me none.
Why not?
It's still at what it was.
But they're doing a research now, so all of that's going to be corrected.
They do their own assessments now every 5 years.
And they send a drone.
And I think they use drones,
Yes, they send a drone over your property and they're backdating it and they're sending you your invoice.
So start saving that money because it can come.
It come in. All those people who usually add it on the side and then they add it on the other side and then they carry it up and then they put a piece on top of the up. All of that is gonna be taxed.
Oh man. I mean, I don't mind the tax ain't what I mind, and the part is the bank ain't helped me with the piece in the back. Why didn't get a slice of my cake? That's what I'm talking about. That's where I find the problem.
What you telling me wasn't from residential to multifamily, but I know of a case where this guy was building this long stretch of apartments, right? When he went to get the mortgage, it only had two apartments on it. But when he started the default, he already had almost 10. And he said that the bank had no right to take the other 8 because they only in the 2. because that's all that was there when he got the mortgage. And the bank told him no.
Yeah, I was going to say the same thing. I was going to say that I think that he's right.
No.
So why couldn't he just use some of his equity to like pay off the whole thing and then just refinance his situation?
No, you making debt, putting debt on top of debt.
I'm just trying to help.
But I don't understand. I don't understand. If he already had a duplex on the property, it was already a commercial situation, right?
No, why then? If you more for commercial.
Oh, okay.
Yeah, you see, yeah. So you need some banks are 3, some are 4. So anytime you pay over a certain amount, then they get you. They don't tell you this in the beginning. They don't. If you don't ask questions,
you just say we get you. What bank you work at?
No, them. Sorry, I thought my bad. They get you. I don't want to work for the bank. They crooks.
What kind of talk is this?
I like them, but they crooks.
How?
Because they don't inform you. You said earlier that Bahamians don't negotiate or whatever, but they don't make things easy for you to negotiate. When my husband and I got our mortgage, we were very young. They didn't tell us anything about negotiating rates and all that kind of other different stuff. So
they didn't tell you that. That's on their interest.
We was like, oh wow, this is, interesting, blah blah blah. I mean, we've paid.
Hold on. Let me give you an example. So you walk inside the food store and you see the milk that you like, and then you see it say $4.59. The other one say $6.59, and you grab. Let's say you didn't know better. You grab the lower one, not knowing that. Guess what? That was expired yesterday. You think they could tell you that? They just swipe it and go. No one is going to tell you. You have to do your own research.
Yeah, we learned that the hard way.
They gave you a 25-year mortgage?
I think it was 30 when we got it. When we got it, it was 30. We was young.
So long.
Young. We were young then. We didn't know no better.
Oh, God. So you paid for your mortgage.
Yeah, we know that. Could you stop? You paying me?
You paid it twice. Yeah, you paid it twice.
Yeah, you're paying me now.
Yeah.
See, and that was my question. That was my part of my question earlier, Miss Archer, right? The equitable interest of being, let's say, if I pay off, I borrow for 100,000, I pay off 50, I have 25 left, and whatever, right? That's however much. 25,000 is my equitable interest, but 25,000 don't mean 25,000 because of the time factor. Because that 25,000 could be for the next 5 years, let's just say. And the interest rate every year on that $25,000 balance. So the penalty, you understand? The penalty of me selling my house or paying off my mortgage earlier.
Interest rate is not over the balance of the 25, The interest rate is the interest rate that was set at the beginning over the whole 50.
But does not diminish as you pay off your principal.
No, it's already set. It's set for 25 years.
No. That's what I learned. No, we can't discuss that.
What do you mean?
What I know it to be with a mortgage, right, is the interest rate that you're paying is going to be on your running, but it's spread out over the cost of the mortgage, yes, but it's basically on the balance of your principal over the years. So of course, as you get to the end of your mortgage, right, your payment's supposed to be, I guess, less, or you're paying more towards your principal, so to speak, because, and that's why that's why they discourage principal payments, because once you're paying on the principal first, right, you paying it off faster, they getting less money at the end of the day, which is why the interest rate structured at the beginning of your mortgage, most of the money that you're paying ain't going to your principal, it's going to your interest.
Yes, correct.
Okay, so if my mortgage rate is 5% for my mortgage, I don't pay 5% mortgage of the $300,000 I borrow straight through. I should be paying that 5% on my reducing balance as I go along. Should I not?
Yeah.
That is what you're paying. That's the reason that as you go along the mortgage, more of it is applied to your principal because the amount calculated per diem on that 5% is less. As the principal amount decreases, the amount being calculated for interest decreases.
Okay, so back to what I'm saying now, when I say the $25,000 left, let's say on my mortgage, right? From the original amount, even though I know my interest rate was, let's say 5%. Towards the end of my mortgage, I didn't pay off $50,000 or $75,000 or whatever, right? I'm still paying that 5% on the balance, which should be that $25,000. Am I not? Okay, so that's what Ms. Mazacha said. Something that looked to sound like it was contradicting that, saying that I'm still paying the 5% on my original cost of my mortgage.
Declining balance.
Or did I hear that wrong?
No, that's what
on the balance, right?
The balance, yes, the balance.
Okay, not a problem. You scammed me just now, Ms. Mazacha.
No.
Okay, Ms. Mazacha. So back to my question. So how do I get my equity out of there?
What do you mean?
Yeah, how am I gonna get my equity out? So let's just say I came in, right, and it was 100,000, right? And so now it's 500,000, right? How do I get my equity out of there without making it commercial?
How do you get an equity without making it commercial?
Yes, ma'am. Homework? Homework.
Hold on.
That's not like homework.
No, go again.
So let's just say the property is an acre. Do I cut it? Is it better if I cut it in half? But they already have the whole thing.
What did you give? What interest did you give the bank? Did you give them interest over the whole acre? So how are you cutting it in half now?
That's what I'm asking you. I'm just asking you if that's a viable.
See, the first thing you did wrong was
I spoke to someone at the bank, right? And that I could possibly cut it in half. Does that sound something that?
So that's the mistake you made right there.
Once the bank holds that, the bank is not going to allow you to do that.
No, they're not going to allow you to do that. You've already given them the interest over the whole land.
Yeah.
You should have really only given them an interest over 50 by 100 or 75, whatever it is.
Right. So, okay. So suppose my equity can cover whatever I owe, right? So let's just say it's 50,000 or whatever, right? Suppose the equity that I have can cover that. Why can't I cut it in half?
Because the greedy banks like it all. Once they have the whole thing,
they're
not going to renegotiate or rewrite that loan. Another friend has that same problem. They're not going to do that.
That sucks.
No, but that's why I'm always saying before you enter into a mortgage or any type of loan, you have to do your homework. You have to.
This class, I was 20 then, you know.
This class is my homework.
You can't, if they're not going to give that back to you.
No, in your point of view, what's the easiest bank to work with?
Ms. Archer, this class is my homework because I have no interest in mortgages as a career path.
Oh, Lord.
This is specifically for when I go get my mortgage that I can finesse and wax eloquently.
So you're looking at domestic banking versus international banking.
Okay.
So if you go international, persons overseas make the decision whether you get the mortgage or not.
Okay.
If you go domestic, then they're local persons.
So you think it's easier to, in Gia's word, finesse a local person than it is to finesse an international person?
Yes, because you're not going to see that international person. You're not even going to speak to them.
Okay.
Because remember, a lot of these functions are outsourced. So the local people are only just gathering the information.
What all banks do we have? International, BOB, and?
No, that's domestic.
I mean domestic. Sorry, my bad.
BOB and Commonwealth Bank.
Essentially, you're saying RBC is better.
RBC is not a local bank.
RBC is RBC.
What do you mean?
Our
RBC?
decisions are local.
What does that mean?
All your decisions are made locally at RBC?
Yes.
Mortgages are made right here locally?
Yes, ma'am.
Yeah.
Wow.
I find that very hard to believe.
I don't
believe it, baby.
I find that very.
It's local though.
So the only local banks that do mortgages would be Commonwealth Bank and BOB?
No.
Credit unions are also become a viable source for mortgages in the market. So don't discredit your local credit union.
I agree.
Unions too? Okay.
You're not. So I'm in Grand Bahama. Grand Bahama Credit Union, we've started more. Up to 300,000. Currently, we're running a special for 6%. We're still a local little credit union, but other credit also offer mortgages. So, for those of you in Nassau, teacher credit union,
the police and law enforcement credit union, they
do, and national. I think National Workers also offers mortgages too.
You have to be law enforcement?
With law enforcement, you have to be a police officer, customs officer, immigration, Royal Bahamas Police Force, or immediate like that. I think that's how they're
bought. Would that work? Would a child work?
Pardon?
Could you be a child of?
Yes.
A child
of someone in law enforcement? Yes.
Mm-hmm. Okay.
You can become a member of law enforcement credit union if you're a child.
What about teachers? What about teachers?
Anyone can join teachers.
Anyone can join teachers because they're an open bond because they're teachers and salaried workers.
Okay.
So why doesn't bankers and financial institution people have our own credit union?
Banks don't like credit unions,
and they don't like unions.
That's a whole. We're not a union.
I'm just saying they don't like the word union. Period.
We just have that word, but credit unions are, and this is a whole other course. We are totally a financial institution geared towards members for savings and for loans for prudent purposes, and it makes it easier because everything is on your savings and your relationship with your credit union. So we try to make it a more personable and an easier situation when it comes to borrowing and lending. And, I've been here 22-ish years, and I would gladly support any credit union because I know what the philosophy behind it is and what the drive is. So I would recommend you don't, look at your local credit union as a viable source for a mortgage.
So that's 6%. How much is BOB?
Thank you, Ms. Russell.
What's the interest rate at BOB?
I think they're like
Anybody
5. I think so. Last time, that was earlier this year.
What is prime currently?
Can't remember.
Prime is 4.25.
Okay. So what is FCIB offering?
Well, if Scotia is offering 3.8, prime can't be that high. Prime got to be lower than that because Scotia going at 3.8.
No, Scotia went below prime.
Scotia went below prime.
That's an introductory rate.
But the house you're going to go
exactly.
That's not for everyone. That's
exactly.
That's one of those disclaimers, right?
Right. That's what I told you. Once you advertise a rate, that is an invitation to treat. So once you get in, you walk in, you think you're going to get 3.8. But when they finish their calculations, they may offer you 4.5, they may offer you 5 or 5.5.
Right, depending on how you qualify. And it's my understanding that Scotia's down payment is significantly more. I think it's 30%.
Yep.
Yeah, that's the payment today. They increased it.
Yeah.
Mm-hmm. So that's why I'm saying you have to shop around and see what fits you. Are you happy now, or are you still trying to figure out how to get your commercial property and
I also think when shopping around, you have to determine what works for you. Like I find that if you're a young professional, I would recommend and tell you to always go to either a credit union or go to First Caribbean. If you work like for a government agency or you work for government typically, or somewhere where they allow salary deductions, I would tell you to go to Commonwealth Bank, just because the relationship isn't as hassled as it is if you go to like an international bank. Like Scotia will ask you for everything, including the kitchen sink. And sometimes people don't have that, and they don't have the 30%. So I would say, depending on like where you work, what it is you're looking for, if you're just a young professional working for a private employer, I would say First Caribbean. Okay. Government, young person, Commonwealth Bank. If you want to refinance and restructure, Bank of the Bahamas.
So when do you go to RBC?
Never.
Well, I will
think only thing I know people go to RBC for, really and truly, like, I mean, a lot of young people trying to get, they don't really go to RBC for a mortgage. I know a lot of people go to RBC because they give good car loans.
Cars.
Yeah, so I don't know much people to go to RBC for young professionals, like say between the ages of like 21 and 35. They tend not to go to RBC. You'll find people more established, more mature, if they have had a credit facility with RBC over years, because there are people who had RBC accounts from when the only branch of RBC was downtown. You'll see that, you know, those customers who have been there for like 50, 60 years, they can go there at the age of like 50, at almost 60 and get a loan or refinance their mortgage. So they do it. It's better for those people up in age. But for young professional people, that's not the Canadian banks are not the banks for young professionals. Same except First Caribbean, depending on who owned them.
Chantel, can you take this one?
Disagree.
Okay. Chantel, take it.
Because first of all, when you think about the RBC brand, RBC targets locals. Our product is geared towards them.
But so how many of them qualify though and get it?
They qualify because we make the product for them. It's very easy for a professional to get a product with RBC. If anything, that's where professionals should go to RBC. Right. They have all of the negotiating power. Anyone else on this call can tell you that if you're a young professional and you come to RBC to get a mortgage, more than likely you're getting that mortgage.
Not the ones that I've seen.
And First Caribbean do not like personal. They don't like private companies. They also go for like government type employees. That's another thing.
I mean, well, every bank would go them. But I know for me and my practice, I know that most people, they'll start off with RBC, and RBC will look so good. Even they'll try with Scotia. And when they're not getting through, I'd be like, well, just go to First Caribbean or Commonwealth and boom. That's it.
I think it's about, again, like Ms. Archer said, shopping around and knowing what each bank offers. Now, I can tell you offhand with my colleagues on the phone, we offer free professional advice. And even if you do not qualify with us today, we will let you know what is the reason you do not qualify. We will let you know what can be done to set yourself up to qualify. And I know for me personally, I weigh out the options with my clients. If the client is a good client and they cannot qualify with us, maybe because they don't have enough injection, I will have that conversation with them about who would possibly fall in line with what they're qualified for. So it's about having the conversation and knowing the client. But in terms of RBC, first and foremost, it's FinCo that does the mortgages. And we offer, I would say, top-notch rates and terms and conditions for our mortgages. But you'd have to know what we offer before you can have that opinion.
Ms. Parishka, can I say something? FinCo takes a very long time to get back to people on your foreclosed property property is. You all take
that's a whole different section. That's
long,
a whole different section.
Long.
Because we try to work with our clients. We don't just be rushing to sell people
y'all
out.
Ain't have to. Y'all ain't have no clients.
As per the Mortgage Protection Act.
Y'all loan
under the Mortgage Protection Act, we are acting within the scope of the law. So it's not a cut and dry process.
No, but it had for sale on it with someone.
But the government put a law in place that you have to work with the homeowners before you can effectively sell it.
I think you hide mine.
No, because I'll be the first to refer you to a property. But if the client is, like if the homeowner is trying to negotiate with the bank to come to some form of agreement, unlike the other people, we can just up and sell the property. And if anything, you should be commended for that.
Okay,
I don't call names.
Okay. Okay, no problem.
Lovely debate, ladies. Love to hear it. Love to see it. It's wonderful.
All right. For real property tax.
Yes, we had real property tax. But of course, at the end of the day, no one still said to go to the credit union. But anyhow, that's fine.
So I can check them out and let you know.
Okay. Real property tax. Of course, you know, the government always have the first lien. So even though the bank itself would register or record its security in the property, the bank, the government, real property tax, by law, has the first charge over the property. So that means that whenever that property is sold, real property tax has to be paid first. And of course, the government can assess real property tax going back 10 years. So the first charge always ranks in priority to the mortgage security interest filed and created by the mortgagee. And so when you look at a piece of property that has been mortgaged, you have it recorded. So you know that you have your, you know that you are the first in time. But by law, real property tax takes precedence over that. So that is always the first. It's automatic. So let's look at remedies of a legal mortgage, of a mortgagee. So whenever you're behind in your mortgage payment, of course, the bank always have the right to sue you. So they can bring an action for debt. And normally this is where you are maybe 2 months behind, maybe 3 months behind. They don't want to get to the point whereby they now have to force you out. So they have steps that they can take before they get to the point of foreclosing. So the first one is they could sue you for whatever amount that you owe. The next step they can do is they can enter into possession. And that's where you go to the court and you tell the court that you need and especially when the person refuses to leave. And that's when you get an eviction order. And of course, the cost for all of this is borne by the mortgagee. Now, there are some restrictions on the bank being able to enter into possession. If it is a home, the court has a discretion to adjourn the action if the mortgagor is likely to be able within a reasonable time to pay. So normally when the banks want to enter into possession, when you go to court, you have to be able to demonstrate that, yes, I was behind, but I am able to pay. And I gave you a case of Cornell versus Maltby. And it suggests that there may be a general discretion in the court to refuse possession to a mortgagee if possession is not sought for the purposes of enforcing the security, but for an ulterior purpose. So whenever the bank goes to the court to say they want to enter into possession, it has to be because the person has not paid or made the repayments on time. Now, if you have, like you say, commercial property, the bank can go to the court and ask for an appointment of a receiver. And the receiver, his job is to make sure to collect the rent. And normally this is only done if the bank wants to continue with the mortgage and the land is income, the property is like income producing. Now, before they appoint a receiver, they'll always do a formal demand for repayment from the customer or the mortgagee. So the bank does make steps to try to recoup his funds before it goes to the court or before it appoints a receiver. So there are extensive case law setting out the duties of a receiver. And I gave you the property here of Sylvan versus Royal Bank of Scotland, and downside Nominees versus First City Corp. So although the receiver is appointed as an agent of the mortgagor, he has to take steps to protect and preserve the mortgage property. And when it comes to selling it, he has the same duties to the mortgagor and others interested in the equity of redemption. So they always have to obtain the best price obtainable. They don't have to try to do any enhancement or delay in order to sell in order to achieve a higher price. They just have to get the best price that's obtainable. So the remedies for entry into possession and appointment of a receiver do not bring the mortgage to an end. So these are just interim measures. The next one is the power of sale. And this gives the mortgagee a statutory power of sale. When they realize that, guess what? This borrower cannot repay. They would seek this remedy in conjunction with vacant possession. And they could either do it under the Law of Conveyancing Act, or they do it under the terms in the contract for the mortgage. So a mortgagee is not a trustee of the power of sale for the mortgagor. And he has an unfettered discretion to sell when he likes to achieve the repayment of the debt which he is owed. So not because he got an eviction order, he's taken possession, he now wants to sell, he got it today means that he must sell it tomorrow. So in particular, the mortgagee need only have regard to his own interests and need not only duty is preserving the value of the security and to obtain the best price that can reasonably be attained. If a mortgagee exercises their power of sale and there are surplus proceeds from the sale, of course, it will go to the borrower. So on the realization of security or the exercise of the power of sale, the mortgagee must act reasonably and obtain a fair price for the mortgage property to be sold under the power of sale. So I give you the case of Standard Chartered Bank versus Walker and Walker. Anyone read that, or you didn't have the time? Hello?
Didn't have the time.
Are we asleep or are we awake?
No, I didn't read. I didn't get up on that case.
Okay. Next class, Natasha.
Next class, you have Mr. Glenn Nottage.
Why you want to stay?
Well, where you going?
Oh no.
Did you check the schedule?
Yes.
Oh, no, you didn't read that.
No, she ain't looking.
I thought it was a typo.
No, it's not a typo.
Oh.
Yes, and a praise.
Who is he?
What? Ask Mr. Miguel. He's the lecturer. You'll tell me when you see me again.
I like when they split you up, massage. I like that.
Why?
I've been at this a long time. I can't say those kind of things. These classes being recorded.
So
I'm sure Mr. Nottage is very capable. I'm looking forward to him teaching my next module.
Of course, he will make it exciting and you can ask him lots of questions and you'll have lots of fun. You'll forget about me. So let's go on.
Never. No.
An appraiser or surveyor who negligently values a house for mortgage purposes so that its for sale value is less than the amount loaned by the mortgagee to the mortgagor will be liable to pay for damages. And I gave you some cases for that also. The timing for the realization of the security or exercise of the power of sale after default is entirely a matter for the bank. The bank is not liable to the mortgagor or surety for a decline in the value of the mortgage property, unless the bank was responsible for that decline. And I gave you a case for that also. China and South Sea Bank versus Tan Sun Jin. In that case, the decision of the court was that a mortgagee's decision on sale is not constrained by reason of the fact that the exercise or non-exercise of the power will occasion loss or damage to the mortgagor. The bank can sit back and do nothing. He's not obliged to take steps to realize his security. Because remember now, when you don't pay, when you default on your mortgage, that mortgage is an asset of the bank. So the bank makes a decision when it's going to sell. He is not obliged to take steps to realize his security. That's the bank's decision. Because that security now becomes an asset on his books. But where a creditor has concurrent remedies against a debtor, a security and a surety, it is a matter for him which one he pursues, if indeed he pursues any at all. So the bank makes a decision when they're going to sell and the price that they're going to sell at, as long as that price is reasonable. So again, I give you some more information on the case of Sylvan Properties versus Royal Bank of Scotland. And in that case, the court held that by accepting office as receivers of the claimant properties, the receivers assumed a fiduciary duty of care for the bank. So you understand what fiduciary duty means?
No.
Okay, so fiduciary duty means that in law, fiduciary duty means that when you take on certain responsibilities, by law, you have to exercise reasonable care and skill, and is expected of you. And when you do not exercise reasonable care and skill in carrying out your actions, you can be sued. So a receiver, when he is acting in the best interest and receiving the funds from the property that is the property that is leased, he has a duty in law in carrying out that act, to act reasonably and in the best interests. And so it says here, the claimants and all others interested in the equity of redemption. The scope or content of the duty depends on the special nature of the relationship between the bank, the claimants, and the receivers, arising under the terms of the mortgage and the appointments of the receivers, and in particular, the role of the receivers in securing repayment of the secured debt and the primacy of their obligations in this regard to the bank. That was inconsistent with the duty to take the pre-marketing steps for which the claimants contended in this action. Note that the court has the power to order the sale of mortgage property, even though a mortgagee may refuse consent to the sale, because the sale would realize insufficient funds to pay off the money advanced by the bank for the mortgage loan. And I give you the case of PALC versus Mortgage Services Funding PLC. The court ordered the sale sought by the mortgagor, refusing to let the mortgagee retain the property and rent it out. The value of the property was insufficient to cover the loan, and the rent would not cover the interest payable, with the result that the mortgagor's liability would increase if the mortgagee remained in possession unless the property values increased steeply. The decision in Target Homes versus Clothier, a bank mortgagee may allow a mortgagor the opportunity to try to sell the mortgage property. As the court held the law, that there may be instances where an occupied property is more attractive than a repossessed property. This is the point that you all raised at the beginning. Remember, you said that when the person is in default, why doesn't the bank let them remain in the property until they get a sale? Again, that's a decision for the bank to make. But in this instance, in this case, the court held the view that there may be instances where an occupied property is more attractive than a repossessed property. And I know a lot of people whose homes were up for sale, this is one of the arguments that they had, but they didn't take it to court. In terms of the sale of the mortgage property by the mortgagor already in default, may also be agreed that after the end of a certain period of time and no sale was made of the property, the mortgagee could take immediate possession of the property subject to the formalities. So there are other alternatives, like when we started this discussion today, that the bank can take, but the borrower will have to take that matter to court. Additionally, a bank, in exercising its power of sale, has no duty towards the beneficiary of a trust, where the mortgagor is a trustee of the trust or mortgage property. And the last one is a foreclosure. So that's under court order, which may be obtained by the lender. Ownership of the property is transferred from the borrower to the bank. So I, just like some of you all, if I had thought about it earlier, I would have never gotten a mortgage.
What's the alternative?
When I add up how much I had spent in paying off that mortgage, it wasn't worth it. I could have traveled the whole world, probably bought a yacht.
But what was the alternative, Ms. Asha?
Stay home and bill it out of your pocket.
Agreed. So Ms. Archer, on page 7, where it says the bank mortgagee, slash mortgagee is not liable to the mortgagor or surety for a decline in the value of the mortgage property unless the bank slash mortgagee was responsible for that decline. Now, I want to ask you, what happens when the bank get people out of a home, right? And then they bought it, whatever, and they only maintain the yard and they don't do any maintenance on the inside of the home. Like, let's say a hurricane comes and some damage is done to the interior of the property. Is that not something, well, I mean, let's not use a hurricane because that's like an act of whatever, but like something happens, right? And it sits for a very long time, and you know, things happen on the inside, I guess, and it deteriorates, or something happens to the roof and rain gets inside. Is that not considered like something where they would be the cause of the decline of the property?
I think only if they didn't secure the property or if they were aware of it and didn't take any mitigating actions.
Right. Okay. Gotcha.
Right.
Okay.
Yeah. Because normally they board up all the windows and they do all of that and make sure everything is secured.
Right. Okay. Okay. But then you notice, like, when they go to sell these properties back to you, do they take into the account you know, like if there's damages or, you know, that kind of stuff? Do they take those kind of things into the account when you buy or repossess a home?
Because I know normally they list it for whatever is the balance of the loan.
Oh, sorry, they said it again. They listed for the balance of the loan. I thought they listed for like the appraised value.
Appraised value. And they try when they sell it to make sure that it covers the amount that is owed.
Oh yeah, okay. So they want, of course they want their money, right? But I don't see them listing a $250,000 worth house for $100,000 if they only have $100,000 left. They have to do it by the appraised value, right?
By the appraised, or whatever value. Yeah, they try to preserve the value of the house. But of course, when you get a repossessed home, you can bargain.
Yeah, they wouldn't use the appraised value to sell it.
No.
Why not?
Because you can't, I mean, at the end of the day, it's not hard enough to sell the house itself. So you trying to get the appraised value, that's longer, like the bank wouldn't be getting their money. So usually a lot of discounts, a lot of negotiation.
They ask you to bid on it.
Yeah.
Did you ask what's the remainment of the balance on the house, and they tell you, or no?
No. And what they do a lot of times too is a lot of mortgagors, when they realize that their house has been sold, a lot of them try to take actions against the bank to say, well, why did you undersell my house? Because they're under the impression that the bank is supposed to sell it for the balance on their loan, and the financial institution is just trying to really, sell it. So it's not, I mean, even though they should try to cover the balance of the loan, not in this day and age, very rarely I've seen that happen. And to somebody else's point earlier, where they said if the house is damaged, and if the bank will for a foreclosed home, if the bank will give you any type of credit for it. I know that there are some well, I mean, if you're talking to like a real estate agent, sometimes when that whole bargaining process, you could bargain a lesser price and say, okay, well, I see a couple of shingles missing, or I see a window blown out and I need to fix this window, and whatever the case may be. So let's take off a couple of dollars or whatever. So you could do that when you're negotiating.
Yeah.
Wouldn't it be the burden? Wouldn't it be like the burden of proof for the person, let's say, buying the house, right? To know, let's just say, okay, apart from, let's say, the shingles being off or a window being blown, which you can see, right?
Right.
There may be damages to the house that, for the person seeing the house for the first time, it may not go detected, right? But let's say if I knew how the house looked before, I could say, hey, this wasn't, this is broken, or this was, this was not supposed to be here. Something is wrong. It'll be the burden of me to prove that, to say that. You understand? And that's not that's not typical. I wouldn't. Where would I have seen a house prior to it being foreclosed to notice the difference? You see what I'm saying?
That's kind of the risk you take when you buy in a foreclosed home. That's why you can't go without your contractor, because when you see a foreclosed home and you see, like, for instance, you walk inside, outside is beautiful, and you go inside and you see stains on the ceiling, or you see a crack in the wall, you need somebody to analyze that, because that could be anywhere from a $200 problem to a $20,000 problem. So that's sort of kind of the risk you take when you get these foreclosed homes.
Right. So even let's say, it's holding the bank, let's say, because like I said, the bank is responsible for maintaining the property, right? And I can then prove them that they didn't, if I'm not sure what I'm looking for, or if I don't have a reference prior to the damage or the negligence being done.
Right. And then another thing is you didn't contract with them earlier. They didn't owe you an obligation before you went to purchase the home. So they're selling the home as is. So they never entered into a contract with you previously. So technically, you really can't sue them for allowing the home to depreciate.
You could just basically say, you would base your contractor's advisement that, this could possibly
like my contractor say, this is how much it can cost to fix this, because this problem is this go to the foundation, and and you say, okay, well, y'all need to knock off $10,000 to $15,000 because this is what my contractor say it can cost me, and you go with your invoices or whatever the case may be.
Okay.
Can I interject, please?
Yes.
I'm not a banker, so I need some clarity here. So therefore, if the bank is going to foreclose on the mortgage, they would normally use the appraised value in the first instance when they go to auction. Not making that sale, they have a certain period of time to say, okay, then we have to go and try the best sale because we don't want it to depreciate.
Right.
Isn't that the case?
Right.
If no one comes and the house depreciates, then this is what you're talking about now. You get your contractor and we go for the best reasonable cost, and the poor homeowner is going to suffer the loss completely.
Yeah. Essentially, and they do go back, and the bank does go back to back to the court to get an amended order to come after you for the difference, if there's a difference.
No way.
Oh, wow.
They do that.
I never heard
Wow,
that.
I didn't know that.
I've never heard that.
What do you mean?
Mm-hmm. If the bank sells the home for, say for instance, your mortgage was $350,000, you foreclose at $275,000, and you're still owing $275,000 on your mortgage, and the bank only gets $200,000 for that property. They're coming after you for the $75,000 plus the interest.
Of course.
Oh yes.
They'll wait that 7 years until I get what's the word?
Limitation period?
Whatever that is. I know 7 days. Every debt expired. Every debt has to be 7 years. Right. They'll wait, they'll perish before they get that $75,000.
Yeah, no, I mean, yeah, but it is possible for them to go after you for the difference.
Yes.
Like every couple of years, they'll come back at it.
Yeah, but if they get a judgment against you, that judgment stands. So whenever you pay them.
And they just enforce it so they could garnish your wages. They could find other means to enforce the judgment.
You get some life insurance, someone died, they'll get it.
And financial institutions will maintain your life insurance for you so that just in case something happened, they can get their funds.
Yep.
And they will charge you for it.
Of course. Of course.
So
isn't it a wonderful business?
This is powerful.
It's a wonderful business.
But what is so sad is that a lot of people don't realize like all of these things until they are in it.
Yes, and then it's too late.
And that is the unfortunate part, and it's too late. And then a lot of times too, like I shouldn't say in recent times, but before, when the market was, a bit more stable, I find that a lot of banks were lending to people who they shouldn't have lent to.
Yes.
And then now we're in this problem.
I
so
agree.
Therefore, they put a lien on judgment for any and file it. So anything coming your way in terms of finances, they have something on that. Wow.
So imagine when the credit bureau comes into effect.
Oh.
And all these garnishings are recorded against people's salary.
I have a question. Ms. Archer. And in theory, and I want to know if it's practical. In a lot of ways, let's say, because the average payment don't get like a trust, right? Let's just say I have my assets in an irrevocable trust, right? Most of them. So that let's just say something happens and I end up in a situation like that. They can't touch the assets of the trust if it's an irrevocable trust, right?
Yeah, but they could get your whatever disbursements.
That's only if I'm a beneficiary.
Yes.
Okay. But if my husband is my beneficiary and he of course still, basically I still have access to my money through my husband. Okay. But it's not my money because it's not in my name. That's a way to protect, some of my assets. But is there any way to use a company to protect your assets as well?
Yes,
so if I buy my house in a company name instead of my personal name, okay, a limited company, and the house forecloses, okay, foreclosure, they can only go the assets in the name of the company, can they not?
Yes.
So why is it not more practical for Bahamians to do?
A lot of Bahamian men do that.
We know why they do that, but I know I'm just trying to think why, like as a young couple going to the bank.
Yeah, you can form a company and put the assets, put the company being owned by, the assets being owned by the company. The only way you go behind the company is when you want to say that it was fraudulently placed in there in order to avoid paying your creditors.
I mean, after the fact, like if you try to do it after the fact, but if I establish my company before I got in, legitimately.
No, if you know you have creditors and then you form a company in order for the creditors not to have access to your.
That's after the fact, right? Same thing with the trust. But I'm just thinking now, because all things being equal, we don't know what happens. We don't know what's going to happen, right? You don't expect, like as I think a previous person said, no one expects to foreclose in their home. No one expects not to be able to make their mortgage. But something like, say, like COVID, I could have been paying my mortgage for 30 years, 20 years or whatever, faithfully, because I have a stable job, and now things are unstable, right? I'm just trying to think of how practical it is, in addition to, let's say, protecting your assets, and there may be other benefits to it. Why wouldn't more young people put their home in a company even before, just initially, just at the start of, because let's just say nothing happens, right? Nothing happens, and you pay off your mortgage and you find, well, no harm, no foul. You didn't risk anything but the incorporation fees every year.
That's just not the natural course of things. I mean,
people normally want things in their own name.
Yeah, it just, I'm not saying you can't do it, but it just isn't natural.
But why? Like, why not? If let's say, even after, let's say after I pay my mortgage now, right? I paid it off, right? I can get my home transferred in my name. Why not? That's for my company's name. Can I not do that?
The amount of documents and stuff they're gonna require you to bring in and produce for that company, you're gonna get so frustrated. You're gonna be like, cheap as I put this in my own name. They're gonna have
the cost factor.
And you have to do that every month. I mean, every year, pretty much.
The cost factor.
Yeah, they're not just gonna put it in a company name willy-nilly. Like, they hip to that trick. Okay. They require like audited statements, letters of good standing. They want to know if you operational. Sometimes they want to know if you have a business plan, But
I'm saying, right? A domiciliary company documents are straightforward, right? The only thing that I guess that is new every year is a certificate of good standing. If it's not an operating company, there is not expected to be any type of audited financials or even activity. You're a domiciliary company.
But they're still gonna approach that with a lot of caution.
Yeah,
that's a big risk. They can take on that risk very easily. Yeah. So it's easier for them to just say no than to give that to you.
Because that's
not necessarily. I deal with especially young professionals who do that all the time. It's not an issue at all.
I don't think it'd be an issue. I know, I'm familiar with corporate documents. I mean, it's a fixed amount. Once you don't not getting into operational stuff, right?
The company is putting a holding company.
I'm a shareholder of my company. I think it only be an issue. Let's just say if I want to get, let's say, another type of loan or mortgage, and I don't have nothing in my physical name, I can only show that I have, something in my company name or whatever. I could see that being a technical problem, but I'm just trying to think about the risk reward factor here. You know what I mean? However, I could see if it was if it was dramatically more expensive. I know it's a little more expensive, but in terms of, me not losing my home and then not coming after all of my other personal assets, I think it's a very practical thing to do as a couple. I know men do it so that their wives can get their assets, they want to control it. It's dispersed after the fact. But I don't see why young people don't do that. You know what I mean? Because when you go for mortgage and yourself, they ask you for everything. All right. If I incorporate a company and I put my house in my company's name, you ask me for my corporate documents.
Just for the record, I'm taking somebody's home. That's usually a very last resort, like a very, very last resort. Usually the bank tries to work with you because it's more practical for you to be a paying person or to keep this thing going, as opposed to going through all the tedious effort of trying to actually sell at home.
Right. I'm aware of that. Yeah.
Yeah. No, I just saying, like, people who lose their homes, that's like really, like, usually dire circumstances, like really, really out of control circumstances. But majority of people, or people who the bank usually tries to work with you because it's more practical for both parties.
I understand that. Yeah. I understand it, but at the same time, you missed 3 payments. That's 3 months. That's it. That's all it takes. For not the house to be sold, but then for you to get into this whole, talking about.
I don't think it's worth. I mean, I understand what you're saying, but the effort that would be to maintain that might not be worth it. And on the side note, you mentioned that you're a shareholder. Would that leave your home exposed to, like, say, a company takeover or whatever?
No. Exactly. No, not for domiciliary company. No, not at all. See, I'm just thinking about, let's say, okay, I work for a private bank, right? So all we have is domcos of foreigners or whatever who have a company in the Bahamas, they put their assets in. right?
Mm-hmm.
So I see the corporate documents, it's the mems and arts and all those other different things. Fine. And that's a way that they can, you know, do their tax planning or, you know, just preserve their assets, diversify, whatever it is. Okay. And they are the either the shareholders or the directors of the company. And that's another way to protect their assets. Now I know a lot of local persons don't do that. Don't bother with domcos at all.
But I mean, these people you talking about is different levels. I mean, like they actually got like numerous of assets.
They got assets, right.
I mean, on our scale, like seriously, person only got maybe one house. You don't really got much, you know.
With no more money in the bank.
You understand? Like it's just one little thing you worry about. So I mean, like with them, the means might justify the reason because they got so much going on. But I think the amount of effort it could take you just to maintain that company thing going on, it should be just pay your mortgage and live your happy life. So, but I don't know.
Okay, so can anybody in here that's a banker or Ms. Archer answer this? So you go to the bank, right? And you are buying a foreclosed home from them, and it requires some work, right? So let's say it's $100,000, but it requires like $20,000 worth of work. Why do they need to? Let's say you don't have the $20,000 to do it, right? And you want to like do it out of your pocket. Why don't they allow you to do it out of your pocket? Why do they want to incorporate that $20,000 into your loan amount? Did that make sense?
Yeah. Make more money.
Why? Why you can't just pay it out your pocket though? Like why you can't
make more money? They make it easy for you because
I know a lot of times that's done to ensure that it's done. So like, for example, especially when it's major renovations to the point that the house, or in perfect case, an apartment to be livable or whatever, to ensure it's done. So yes, case in point, like if this is an apartment you are purchasing where you expect to get income or whatever, you want to ensure that the person is in that position, or that if the renovations are done. Because a lot of time people have contentious but never get around to doing it.
Never get it done.
And the bank could
okay, gotcha.
So lending the money as well.
Do they make that a requirement?
Right, and so I guess they
actually
say. So I know, like even with us, like if you start a project, they making sure that you have enough to actually finish the project. Because imagine how frustrating it is. You just say, in case in point, you paying for a mortgage that you don't have the house to live in. Like, if you get what I'm saying, like it not setting people up for failure. So you've been thinking on behalf of the customer, things that they might not think, to prevent future problems. Because if a person paying a mortgage and don't even have the house to live in, just out of frustration, a lot of other issues gonna spiral out of that. So
how are they ensuring that you're actually doing the work? Does somebody come out and like check, or how does that process work?
Usually that's dispersed in
stages.
Dispersed in stages. So like if the project, just a small project, say 40,000 or whatever, you get a payment, 10,000, they can drop to do the work. Once each show it done, you give them another 10 until they complete it.
Okay, gotcha. Okay.
So they control it. Okay. Any more questions?
I have a question with regards to the cases. Sorry. Are we expected to know only what's been indicated here, or we need to go more in depth in terms of exam?
No, just what's here.
Okay.
I won't put you to that much work. But if you wish, I can.
No, no, massage. Thank you. Thank you.
Stick to the ones that I hear. Yes. All right. So that's
right,
right.
Miss Archer.
Just
sorry, two questions. I'm going back to module 1 for stamp duty. I just have a scenario. I guess maybe you could provide guidance. So let's say, for example, someone gifts me a property that they would have paid for in full, and they would have already paid the stamp tax on it. If everything is free and clear, and they gift the property to me, when I go to the bank and request financing for construction, do I pay stamp tax on the property again, or no? How does that work?
No, as long as you don't sell the property within 7 years of receipt.
Okay, within 7 years. So
Yeah,
you just pay
the transfer.
Sorry, I didn't hear you.
As long as it's not done within 7 years from the date of the transfer.
Okay. But if they provide me with a bill of sale, so it's better for them to gift me instead of providing me with a bill of sale, even though I didn't technically pay for it.
Yes.
Okay. So is that like, does that have to take like on a certain template with the gift, or just a letter, like maybe a notarized letter, or is there a certain format?
A deed of gift, eh?
The deed of transfer is a similar document like a conveyance. So the document is referred to as a deed of transfer.
Yeah, I'll say deed of gift.
Okay, sorry, that was feedback. I didn't hear the responses. Hello?
Yes, which part you didn't hear?
Someone said there's a deed of gift, so that's something I have to go to a lawyer for?
Yes, it's the deed of transfer.
Yeah.
Attorney prepares it for you. It's a legal document.
Okay, all right, thank you. And in addition to the quieting procedure, I know it was mentioned previously in terms of it's placed in the newspaper, and the owner would have a specific time frame. It's 12 years for private and then 30 years for government. At what point are you able to start the process of quieting? Do you have to wait until 12 years is up before starting the process? Okay.
And that's 12 years. That's 12 years without a break. Remember I said if you're on the property, let's say you're on the property for 11 years and 2 months, and the owner shows up and says, this is my property. Your time spent has disappeared. You start over from the next day.
Okay, so let's say, for example, I've been maintaining the property for over 12 years. I can start the process in terms of going to the Supreme Court.
Yes, and the ad goes in the paper to see if anyone is going to claim the property.
But you started the Supreme Court. Okay, and in terms of, would you need a legal description of the property, or?
Yes.
Would the Supreme Court assist with that, or you have to go to Atlanta?
A lawyer.
Okay, so seek a lawyer first.
You have to seek a lawyer, yes.
Oh, okay.
Because they'll actually go and check the title themselves. Before they come back and tell you, yes, I think you have some grounds.
Okay. Just things I was thinking of as I was studying, so just wanted to get clarity.
Okay.
Thank you.
I thought you was trying to get somebody property.
Oh, no.
Just
I have my own.
Just checking.
All
right. So half the class is falling asleep.
Oh, gee, yeah.
You hear that, right? Yes. So good night. I'll see you all in a few weeks.
We'll see you in a few weeks then.
Yes, in a few weeks.
Wow.
Good night, Ms. Archer.
If we need to keep in contact with you, what do we do? Because I sent you an email. I'm not sure if I have the right email address for you.
Also, when are you going to send us those practice questions?
I'm going to write it while you're with Mr. Nottage. Worry not.
Question. One question. Just for clarity. Other than the final exam, any other graded things I'll have to worry about? I ain't sure I missed that memo.
What do you mean?
I only have to worry about the final exam, right?
Only the final exam.
Okay, that's all I want to confirm. Thank you.
And the request last week was they wanted to see what my questions would look like. So I'm going to send you all a question.
Okay.
You'll have an idea when you get on the exam.
And Ms. Archer, I know you be in terms of these cases, will we have to know like full details, or will we just have them for reference purposes?
Well,
so like if a question is asked, sorry.
Then you'll use it as reference, but you'll also say what was in the case that solidifies the point you're making.
Okay.
Yeah.
So would there be an instance where you, let's say you ask a question and you reference the case without providing like certain details?
I could do that.
Wow. It's a lot of cases.
It is not. It's just come on.
Okay.
So will we have to know the recording reference of the case? Will we have to know like the case year and number? Okay.
No, just the name. Just the name. You don't have to go that far. Not at all. Not at all. All right?
All right.
Okay.
Sorry, Ms. Archer, I think you were going to give your email.
You'll see it when I send you the question.
Okay, thank you.
It's easier. So when I send the question, then you'll see my email, and then you could send me a note if necessary. Only
These
if
questions coming with the answers?
No. No, you can figure it out and send it back to me.
Okay, good.
All right. So give me enough time to think of something, and I'm gonna send it to you. And then you could go from there. All right.
Cool.
Okay. All right. So have a great evening. Get your supper, relax, read the chapter again, and get prepared for Mr. Nottage for next week.
Mm-hmm.
All right. Okay.
Good night.
Let me tell you.
So good night. Thank you.
So Ms. Archer, when will you be back?
November something.
Okay.
I think he sent the revised, didn't he? Miguel sent a revised schedule?
Yeah, he did.
He did.
You're right. So,
okay, I'll have to double check.
Hold on, I'm looking at it right now.
Okay.
Yes, that's November 17th.
There we go. Yeah.
November 7th.
17th of November.
Okay, well, we'll miss you.
Okay, I'll miss you all too. I'll look forward to seeing my answers. Yes. All right. So talk to you later.
Good night.
Good night. Good night.
Good night.
Good night.
Good night. Let's see.